Have you ever wondered how Wall Street seems to know a market crash is coming before anyone else? It feels like they have a crystal ball, right? While the big players on Wall Street might look like they're just getting lucky, the truth is far more calculated. They're not just guessing. They're using sophisticated tools and strategies that give them a massive edge. And today, I'm going to pull back the curtain and show you one of their biggest secrets, a powerful algorithm that helps them anticipate market downturns. This isn't about predicting the future with 100% accuracy. Nobody can do that. Instead, it's about understanding risk and making smarter decisions when the markets get shaky. By the end of this video, you'll understand the logic behind how these systems work, and you'll be able to spot the same warning signs they do. First, let's get one thing straight. There isn't just one single, magical algorithm. Wall Street is a collection of different firms, hedge funds, and investment banks, and they all have their own proprietary systems. However, many of these systems are built on similar core principles. They're all trying to answer the same question. When is the risk of a significant market drop high enough that we need to change our strategy? To do this, they don't just look at stock prices, they look at a whole universe of data. Think of it like a weather forecast. A good meteorologist doesn't just check the temperature. They look at wind speed, humidity, barometric pressure, and satellite imagery to build a complete picture. Wall Street's algorithms do the same thing, but for the economy. So what kind of data are we talking about? Let's break it down into a few key categories. The first and most obvious is market data. This includes things like stock prices, trading volume, and market volatility. One of the most famous indicators here is the VIX, often called the fear index. When the VIX is low, investors are calm and confident. But when it starts to spike, it means fear and uncertainty are creeping into the market, which can be a classic precursor to a sell-off. The algorithms constantly monitor the VIX and the rate at which it's changing. A slow, steady rise is one thing, but a sudden sharp explosion in the VIX is a major red flag. They also look at market breadth. Are most stocks going up, or are the gains concentrated in just a few mega-cap names? If only a handful of stocks are propping up the entire market, it's a sign of weakness under the surface. Next up is economic data. This is the big picture stuff. The algorithm ingests a massive amount of information about the health of the economy. We're talking about things like inflation rates, unemployment numbers, GDP growth, and manufacturing reports. For example, consistently high inflation can force the central bank to raise interest rates. Higher interest rates make it more expensive for companies to borrow money and can slow down economic growth, which is generally bad for stocks. The algorithm doesn't just look at a single report, it looks for trends. Is unemployment ticking up month after month? Is consumer confidence steadily declining? These are slow-moving trends that can signal a recession is on the horizon, long before it becomes front-page news. Another crucial piece of the puzzle is credit market data. This is an area that many retail investors overlook, but it's one of the most important signals for Wall Street. The credit market is where companies and governments go to borrow money. When lenders get nervous, they start demanding higher interest rates to compensate for the increased risk. This is measured by something called credit spreads. That's the difference in the interest rate between a safe government bond and a riskier corporate bond. When credit spreads start to widen, it means lenders are worried that companies might not be able to pay back their debts. This is a huge warning sign. Think back to 2008. The credit markets started freezing up long before the stock market truly crashed. The algorithms are programmed to watch these spreads like a hawk. A rapid widening is like a smoke alarm for the financial system. Then there's the more exotic stuff. Alternative data. This is where things get really interesting. Hedge funds spend millions of dollars on data that you and I don't typically see. This could be anything from satellite images of factory parking lots to track manufacturing activity to credit card transaction data to gauge consumer spending in real time. They might analyze the sentiment of news articles and social media posts using natural language processing to measure public mood. Are people searching for recession more often? Is the tone of corporate earnings calls becoming more pessimistic? This alternative data gives them a real-time pulse on the economy that traditional economic reports, which are often delayed by weeks or months, simply can't provide. It's their secret weapon for getting ahead of the curve. So how does the algorithm put all of this together? This is where machine learning comes in. The system is trained on decades of historical data, including every past market crash and recovery. It learns to recognize the specific patterns of data points that have historically preceded a major downturn. It's not just looking at one indicator in isolation. It's looking at the complex interplay between dozens or even hundreds of variables. For example, it might learn that a combination of a rising VIX, widening credit spreads, and declining consumer sentiment has been followed by a market drop of over 20% with a high probability in the past. It's all about pattern recognition on a massive scale. When the algorithm detects a dangerous pattern, it doesn't just flash a big red light that says sell everything. Instead, it typically generates a risk score. This score might range from 1 to 100, where a low score means conditions are safe, and a high score means the risk of a crash is elevated. A fund manager can then use this score to make decisions. If the risk score moves from, say, 30 to 70, they might decide to reduce their stock exposure, buy protective options, or shift money into safer assets, like bonds or gold. It's not about being all in or all out. It's about dynamically adjusting your portfolio based on the level of risk in the environment. This is the key to their strategy: risk management, not market timing. They're not trying to sell at the absolute top and buy at the absolute bottom. They are trying to avoid catastrophic losses, which is the true secret to long-term wealth creation. Now you might be thinking, this is great for Wall Street, but what about me? I don't have a supercomputer or access to satellite data. And you're right. You can't replicate these systems exactly, but you can apply the same principles. You can create your own simplified version of this algorithm by building a dashboard of key indicators. First, watch the VIX. You can easily track it on any financial website. When it's above 20, be cautious. When it spikes above 30 or 40, it's a sign of extreme fear. Second, keep an eye on the 10-year Treasury yield. It's a good barometer for the economy. A rapidly falling yield can sometimes signal a flight to safety, where investors are dumping stocks for the safety of government bonds. Third, look at the big picture. Read about inflation, unemployment, and GDP. You don't need to be an economist, but you should have a general sense of whether the economic backdrop is getting better or worse. Most importantly, adopt the same mindset. Don't try to predict the future. Instead, focus on managing risk. Have a plan in place before the market starts to fall. Know what you will do if the market drops 10%, 20%, or more. Will you sell certain positions? Will you rebalance your portfolio? Or will you see it as a buying opportunity? Having a plan prevents you from making emotional decisions in the heat of the moment. Panic selling during a crash is the single biggest destroyer of wealth for individual investors. The Wall Street pros use their algorithms to stay disciplined and systematic. You can use your own checklist and your own predetermined plan to do the exact same thing. The big takeaway here is that Wall Street's edge doesn't come from magic. It comes from a systematic, data-driven approach to risk management. They gather vast amounts of information, use powerful technology to find patterns, and act decisively but not emotionally. By understanding their methods, by watching market fear, economic trends, and credit conditions, you can become a much smarter and more resilient investor. You can learn to see the storm clouds gathering on the horizon and take steps to protect your portfolio before the rain starts to pour. It's just about shifting your focus from trying to get rich quick to ensuring you don't get poor quick. And that, ultimately, is how you win the long game in investing. Thanks so much for watching. If you found this breakdown helpful, do me a favor and hit that like button and subscribe for more content that demystifies the world of finance. Let me know in the comments which of these indicators you find most useful. Stay safe and invest smart. See you in the next video.